Thanks for the opportunity, actually, because it's something I am really passionate about. So my name's Julie Raikes, and I started my business coming up for 13 years ago now. So it's yeah, it's kind of well established, but it's evolved as well, as often businesses do. Start off in sort of, you think you've got the direction in mind, and then as you start to do things, it sort of branches off into other things, depending on what you're enjoying really and what your priorities are, sometimes where the money is. But yeah, 13 years, and I'm a chartered management accountant. So my focus in business has always been really on working with companies to help them develop their business. So growth, keeping an eye on what's going on in their business, helping them, you know, with SWOT analysis, all that sort of stuff to move forward. So I've been a finance director, financial controller, and that's been my focus. So for me, the finance, the bit I'm doing today, which is a lot to do with sort of the end of the year and the tax return, is actually, that's a compliance bit, but it's actually for me the most boring bit. It's also the bit that's you know, you have to do it. It's at the end of the year, but it's not. It's important because you have to comply. But in terms of your business, you're developing your business, you're growing your business. Then for me, it's the monitoring, the reviewing, the understanding what's going on in your business month in, month out, that actually helps you from a financial point of view. So
that's my phone, sorry.
That's okay.
It'll go off in a second. I'll mute myself.
Okay. So that's it. This is the bit I'm doing, but that's the important bit, and that's the bit I've been focused on. However, in 13 years, what I found my niche is, and it's happened purely by accident really, is working with startups and small businesses. And the main reason is that I find it's a sector that really struggle with the compliance side of it. Not so much to do it, but more with the concept of it, the worry of it, you know, understanding it, and also having the time for it, because when you're a bigger business, you've got people who can do different things, and you don't have to do this stuff necessarily, or all of it. When you're small, as we were saying earlier, Jeanette, you know, you have to do everything. So it's really important that, you know, it's a worry. So I found that this is a niche I love doing, because actually it's not that difficult. It's scarier than it sounds scary, and it feels scarier than it is. And if you simplify it and break it down, there's not a lot to it. And you know, often out there's all this scary stuff, and HMRC and penalties and massive tax bills and VAT bills and things, and people worry about this, when actually, when you're starting a business, you want to be worried, you want to be focused on what you're doing and what you're good at, not worrying about this stuff. So that's the reason I'm doing what I'm doing, and why I'm delighted actually to be doing this, because for me this is, you know, it's critical, it's really important. So I'm going to share, if I can work out how to do this now. Oh, select basic screen, that one. Oh, sorry, I've not done this before.
Brilliant, works perfectly.
Mm-hmm.
Now then, can you see that okay?
Yeah,
it's perfect, Julie, perfect.
Excellent. Okay, so what we're going to cover is a little bit about HMRC's deadlines and the reasons for that, the login links you'll need if you're going to report your own tax return. You still need them really, because there's information on there that's useful for you. The information you need to hand when you're sitting down to prepare your tax return, completing the self-assessment tax return itself. I'm not going to go through the questions, but I'm going to sort of pick out a few things that you just need to watch out for and that will help you. Putting your accounts together, very simply. Some of the expenses people tend to forget. Tax and national insurance, it's different to employment, so it's just understanding what that is. A few good practice tips, and then I'm opening it up for questions. But if there are any questions as we go along, feel free to ask, and I will answer them as we go along if I can. If I feel that there's a fuller explanation later on, then we'll park it and look at it then. So first of all, we're looking at the HM Revenue and Customs. Now, they're set up to make sure that the Treasury get all the tax that's due. So they are, in a sense, there to police all of us, to make sure that we report our profits that or our income. Of course, they deal with employment as well, and to make sure that we're doing everything properly, both, you know, that we're not making mistakes, but also that we're not being fraudulent as well. So there is an element that's kind of feels a bit scary, because that's what their job is, to get as much money for the Treasury as they can. So that's their purpose, really. That gov.uk, it's a really, their website is really good, to be fair, and where you will sometimes get inspectors or people on the phone who are really quite, they're old school HMRC, and they can be quite difficult, but you know, it's a different beast now to what it was years ago. They know, they understand that, you know, by helping people, especially people who are starting their businesses, who've got very small businesses, that it's in their interest to help them get it right and to understand what they're doing, because that way people will report correctly and will keep in touch as well. The scarier they make it, the more reluctant people are to sort of engage and to respond and to be honest with them about their problems, I suppose. So their website is excellent. There are loads of resources on there, and you can sign up for some free webinars. There's lots of free webinars on there which are really useful, and you can just take out of them what you want and what's relevant for you at the time, because it'll change as your business develops. Using HMRC, as I said, for all the resources, that's really good. Contacting them by telephone is a real challenge if you're not an agent, and you can be on the phone. They are open from 8 AM to 8 PM. So my advice is call at 8 AM or 8 PM, because that's the quietest times, but it is a bit of a challenge. Using the website as much as possible, or their online sort of contact form is a much better option if you don't need to speak to them. I put don't avoid here. I put avoiding them on, and as Dewi pointed out, it wasn't me trying to tell you to avoid HMRC. It was trying to say about the dangers of avoiding HMRC, and because they can be quite scary, people tend to. I've had a lot of clients who, I suppose they do it with other things as well. A lot of people, you know, things they don't want to face. They don't want to face those bills. They don't want to look at that, maybe that penalty, or they don't want to see what tax they've got coming. So they just don't open the envelope and they leave it on a pile. Or, you know, if they're being asked to contact HMRC, they just don't respond. They just hope it'll go away. It's the worst thing you can do. I find HMRC, particularly when you're a small business, are really understanding in the main. They're very supportive. They understand that for people it's quite challenging in the beginning. And actually, if you contact them, even if there are things like, if you've had penalties for whatever reason, if there is tax due that you can't pay for whatever reason, they will try and work with you. So it's the best policy is to actually contact them and be honest about where you are with the situation, and then they will support you. And they will avoid then taking action and pushing those penalties. The worst thing you can do, avoid it, because they just start to push it harder and harder. You get more and more penalties. They start to go through the debt collecting system and all those horrible things, because then nobody's responding to them. So that's my advice is, you know, keep in contact with HMRC. They will be there to help you. The one thing I would say is there are some that are old school there still, and sometimes you can get somebody who is quite difficult. If you phone them and speak to them and you find you're uncomfortable, you don't feel that they're listening to you, you don't feel that they're understanding your problem, and they're just really being difficult and tough, I put the phone down and phone back. Very rare will you get the same person, make an excuse, put the phone down and ring again, and you'll get somebody else. As I said, they do tend to be in a minority, but I find sometimes there can be a huge, you know, difference between people who are really helpful and supportive, and then you get the odd one that's a bit challenging. So that, again, that's my advice. and satisfying them then really is just about, you know, working with them, I think, so that they understand. So next one, login into HMRC. So I'm guessing that most people will have registered for self-assessment by the time that you do this webinar. They generally prefer you to register within 3 months of starting trading, and starting trading means when you do your first sales invoice. However, for a lot of people, especially if you're starting, you know, before you've finished your job, so very, very part-time, there might not be a lot. So, you know, if your turnover's under £1,000, don't worry about it. But what I would say is the minute you start being serious and you're invoicing on a regular basis, you need to register for self-employment, and you can backdate it, and they're fairly understanding if people have missed that opportunity. So you need to get registered, and that's really easy on the government website, gov.uk website, to register self-employed. From that, you will be issued a unique tax reference. It's a 10-digit number unique to you. It's a little bit like your national insurance number, but it's only for people that are completing self-assessment. So that's the number that you will use in all your contact with HMRC. And that is not just people who set up self-employed, but this is people who need to account to HMRC for whatever other reasons. So other than being employed, so it could be that you need to declare income for rental property, for maybe you've had some pension income, maybe you're receiving dividends. So there's a lot of reasons why people would need to do a self-assessment tax return and would have a unique tax reference. And then from that, you can get your gateway login. So again, that's basically your unique number and a password. And that allows you to access your own area on HMRC, where you can find lots of information. You can find your current position where you are, and there will be lots of notification about what you need to do when. So that's the main thing for registering. Some of the key dates as a self-employed person. So this is somebody who's got a business, self-employed, not a limited company, but a setup as a self-employed businesses. And it's usually the way that most people will set up their business initially. It's the simplest way, it's less compliant, it's cheaper, it's more challenging to do tax returns and to comply with Companies House if you don't have an accountant, if you're a limited company. So again, this is a lot simpler. And so these are the deadlines for self-employment. So the 31st of January of any year is the deadline by which you must report your income and expenditure for your business for the previous 5th of April. So the 5th of April, your accounts up to the 5th of April 2020 that must be reported to HMRC by the 31st of January 2021. So you get plenty of time from the time you finish your business at the 5th of April, your year-end date, until you actually have to then send that information to HMRC. At the same time, that deadline for the 31st of January is also the point where the tax needs to be paid. So if you're doing your tax return and you are not doing it until January, and this is, you know, I just said earlier, January is a really bad month for me, but I really push my clients to do them early. First of all, because for me, it's a challenging time. January is just a nightmare. What it doesn't allow is, if you do a set of accounts in January, it doesn't give you much time to review what you've done, to look at the different situations. If there is some tax planning and some tax management you can do to reduce your tax bill, then it doesn't give you the time to do that. And it also doesn't give you time to save for tax. So one of the biggest shocks, I think, from being employed is that your tax and national insurance is deducted automatically when you're employed. So you never see that money. And actually, if you look at your P60 at the end of the year and you see how much tax, and oh, why is it? It must be going backwards. Okay, let's go back. So if you go, if you look at your P60 at the end of the year and see how much tax and national insurance you paid, you'd be horrified to think that you had to pay that all in one lump sum at the end of the year. Unfortunately, when you're self-employed, that's exactly what has to happen. So if you haven't been employed and you haven't paid any tax, all that tax and national insurance that's due is due in one lump sum. And so it's really good to do your accounts early. So if your year end is the 5th of April, you start to do your accounts in May, June, July, get your accounts done. You've got a good idea what your tax bill is going to be before the following January. It gives you a chance to save. I'm also going to talk about payments on accounts a little bit later on as well, because that can potentially be an issue and catch a lot of people out. And that's 31st of July where the second payment on account is due. But as I said, I'll explain that further later on. If you are still employed and running your self-employed business, which you can do, you can have as many employments as you want, you can have as many jobs as you want, you can have as many self-employed businesses as you want, so long as you're accounting for it, that's absolutely fine. But if you are employed and if you would prefer for the tax that's due on your self-employed business to be collected through your tax return, so you're paying through your coding notice with employment, then you have to get your return completed by the 30th of December so that HMRC can notify your employer of the new tax code change. So just bear that in mind. And then the other one is the year-end retaining paperwork. So 6 years from the year-end date is you have to retain all your paperwork, because remember that HMRC can call upon you to prove what you've done. And if they can go back 6 years. So if they find that you've done something, it's not usually a mistake. If somebody's done something deliberately, they will, or really negligently, they will go back, because obviously there's previous years. If you've done it similar, then you're likely to have underpaid tax in previous years as well. So those are your deadlines, but I'm hoping you can see that actually you get plenty of time. So whilst there are these deadlines, don't treat them as a target point. A lot of people who are busy with their business tend to put it off, and it's a natural thing to do because we deal with stuff that's urgent, not necessarily important, and so we get all the urgent stuff done and we keep putting back the accounts and the tax return because it doesn't have to actually go in till January. But for all those reasons I said, you know, make a point of spending some time on it beforehand. Apart from the fact that you need to understand what's going on in your business. So if you're not looking at it, you're not looking at your income, you're not reviewing your expenditure and what you're spending money on, what your profit's looking like throughout the year, then you're not really understanding how your business is doing. So it makes sense to me to do it at least monthly. The information to hand that you need when you're completing your tax return is it depends on what income you've had. So if you have been employed during the year or part of the year, then you would need, I'm sorry, right, there's a visitor, he's gone. If you've been employed, if you're still employed, you'll get a P60 at the end of the year to confirm the money you've had from employment and the tax you paid. If you were employed in the year, maybe you left to start your business, then you'll have a P45. But either way, you will need that document because you need to input the amount of pay, what you've been paid, and the amount of tax that's been deducted. If you had any benefits from employment, like maybe a car or private health insurance, then that's a benefit in kind. There's a cash value to that. So you have to declare that as well. But your employer will have given you a P11D at the same time as your P60. So yeah, then the next step is for student loan. So your student loan, if you've got a student loan, you would have had to pay that during the year through employer potentially. If your income was really low, then you may not have. But when you file your tax return, if your income's relatively over a certain limit, and it does depend on the loan, the type of loan you had, then you will have to repay a student loan as well. So again, having that information to hand is useful. And details about any other income that you've received. So if you've had dividend, if you're a limited company, you've paid yourself dividends, then that will be declared. If you happen to own a property that you rent out, that will be declared. Any pension income, if you're that age, or if you're someone who has taken something out of your pension. So when you reach 55, you can take 25% tax-free. It's taxable income. Anybody who's on any taxable benefits, some of the benefits are taxable, so they have to be declared. But if you need to get all that information to hand, and it just makes it a lot easier then for when you're sort of completing your tax return. So actually completing the self-assessment tax return, when you go into your area on your gateway, there's loads and loads of them. And the hardest thing, one of the hardest things I think, is understanding which ones are going to be relevant for you to fill in and which ones aren't. But most of them are optional. So it's just a case of slowly working through the questions to identify what is relevant to you. And you will notice that a lot of them are optional. So, for example, one of the options is to put your postcode of the business, your business. Now, for a lot of people, that'll be your home postcode as well. But it's an optional question. You don't have to complete it. So just have a look, because there are some questions you don't need to complete if it's not relevant, or if it's an optional question. There are also some really useful help links. So next to the question, you'll find a little question mark. And if you click on that, it opens up a box with lots of additional information that helps you to try to understand exactly what they're looking for and what they're asking. So again, use that and try to understand, you know, if that is relevant to you or not. Ensure you complete all the questions. Any questions which are not optional, when you click at the end of each page onto the next page, it will tell you, there'll be a warning box. You know, you'll be used to seeing that when you complete online forms. If there's something not completed that you have to complete, then it will throw up a warning box and you just go back and complete it. The other good thing I think about the self-assessment tax return is that you can complete it and then it saves it. So if you get to a point and you think, oh, I forgot to get that information, or I'm not sure what that means, I need to do a little bit of checking on that, you can stop at that point and go back to it at a later point, and it retains what you've put in. So that's really useful. It's really handy because it estimates the tax as well that you would pay it as it stands at the moment. So for example, if you complete it based on the questions that you've got and based on your accounts, it will tell you the tax that's due. You don't have to submit your return until the 31st of January, but there is absolutely nothing stopping you completing it in, say, July. And then you've got most of it completed, you know roughly what your tax bill is going to be, but actually you might go away and think, right, well, I'm just going to go away. It's a bit higher than I thought, that tax bill. I'm going to go away and just double check that I've put all my receipts in. I've been through my bank statements. There's nothing I've missed before I then submit it. So it is a really useful tool that way, and it will give you that idea of what of the tax that you need to save up for really by the 31st of January. I'm looking at my notes just to make sure I haven't missed anything really. The self-employment section is actually quite simple for most people. As I said, your business postcode, you don't have to fill in. Your business name can be just your name. You don't need a name like you do with a limited company. You have to have a registered name. It needs to be a unique name. But with a sole trader business, the self-employment section is just your name will do. If you want to call yourself Jeanette Baker Aromatherapy, then you can call yourself that. If you want, you know, if you've got a business name, put your business name in there. It doesn't matter to the revenue, because for self-employment, you are your business. In a limited company, the limited company stands alone. You are not earning from that, only if you pay yourself a salary or a dividend. With a self-employed business, you are your business. So it's irrelevant to the revenue if you call yourself something. It might be useful though if you've got a couple of different businesses to give them a different name just for your own benefit. I hope I'm not going too low in terms of experience and knowledge at this, but it's something that I find people new to business struggle a lot with in the terminology of turnover, sales and profit. And you pay tax on your profit, not on your turnover. So your turnover is what you're turning over in goods. So if you're selling microwaves, it would be the value of the number of microwaves you've sold. And so it doesn't matter what it's cost you to buy those microwaves, or to buy in the parts to make the microwaves, or how many people you've employed to make them. None of that matters. It's the turnover is just what you've sold them at, basically. And this year, for anybody that's been self-employed for a year or two, you may have received the self-employed income support grant if you had an income in 2018-19. And that grant has to be reported as income in your accounts. It's not turnover because it's not you selling. It will be classed as other income. It's still an income figure, but you will need to show it separate because it's not part of your trading income. And the other thing to remember as well is if you are VAT registered, then the figures that go into your accounts are the net figures. That means less VAT, before VAT was added. Your accounts are just showing the difference between your income and expenditure, and VAT is something which is just it's just paid by one, offset by another in business out there. It's not part of your income. It's just something that's additional. So never show any VAT on anything if you are VAT registered. If you're not VAT registered, so if you've paid £100 for some stationery, but actually it's £120 because of the VAT, and you're not VAT registered, then it's £120 goes in your accounts because that's what it's costing you, because you can't claim that £20 back. If you're VAT registered, it goes in at £100 and the £20 goes into a separate account. But that's just so you know that. The threshold, I don't know if I put it on another one, but the threshold for VAT is 85,000 turnover. If your turnover reaches 85,000, you have to register for VAT, whether you like it or not. And you need to keep an eye on where you are with things, because you cannot retrospectively register. Well, you can, but the problem is if you've invoiced your clients, you can't go back to your clients and say, oh, sorry, I forgot to add VAT. Now, it wouldn't be a problem if it was a company that was VAT registered themselves, because they can just claim the VAT back anyway. But if you're business to consumer and you have charged your clients, and then suddenly you think you find out you should have been VAT registered because you breached that threshold, it's going to cost you that 20% from the point that you breach the threshold, and they'll need to see the figures. So another reason to keep on top of where you are, to keep on top of your accounts, because if you can see that you're going to breach that threshold, then you need to register in advance. It's relatively straightforward, but that's just another thing again. Until you get there, do not worry about VAT. Again, this is another thing that scares people. Don't worry about VAT. You don't need to be concerned about it. It's not relevant. But just so you know, you can voluntarily register for VAT as well. So if you are a business that does business to business, and so therefore your customers don't care whether you've got VAT or not because they can claim it back, you may want to register for VAT way before the threshold, because it would mean that you can claim VAT back on all your purchases and expenses. So you can do that if you wish to. On the actual, going back to the tax return now, when you input the figures, you don't need to break it down. Now, when you're doing a set of accounts, you would put in things like how much it's cost you for materials, for salaries, for stationery, for renting your premises. You'd break all that down into different headings so you can see exactly how much you're spending in each of those categories. But as a small business, until you reach that 85,000, when you complete the actual tax return, all the revenue require of you is to put one total for expenditure in. So if you're, you know, if your income for the year is 30,000 and your expenditure for year is 20,000, then that's all you put in. They don't need that breakdown. You can, if you want to, put it in, but again, I tend to just complete what I need to rather than what's there. You know, it's up to you really. And the only other bit that's a bit challenging is capital allowances. It's quite a difficult thing to explain, but it's basically means that when you buy equipment, things that are what we call capital expense, these are things that will last you longer than a year. So things like stationery and you travel, that sort of thing, they're used up in the year, therefore they are an expense of that accounting year. Things like vans, computers, desks, if you're building an office, you're building a treatment room, things like that, they will last much longer than a year. Therefore, you have to spread the cost of that over the years. So if the van's going to last 5 years, then you would normally spread the cost of that over 5 years, because that's fair. That's treating your accounts fairly in that you're going to use a bit of that van up in all of those years. Capital allowances, the revenue allow you to claim 100% in the first year on most things that you introduce. Anything that you can bring into your business, it has to be capital allowances is 18% over writing down. So you write off 18% every year until it's all used up. So again, it's a little bit more complicated. You'd need to look into it, or you'd need to just clarify with an accountant really to get that right. But I think the important thing to remember is that you can charge to your business things that you're introducing. So if you've got a laptop that you bought a year before you started your business, you paid £500 for it, and actually now from the time you start your business, you're going to be using it for your business rather than your personal use, then that is a business asset. So you give it a value, so it might be valued about £300 now, second hand. That is £300 that goes into business as a cost. So it's an expense you can set off against your business. So again, same with desks, same with sometimes vans. Sometimes people have got vans or cars. Sometimes there's other equipment, tools. If it's tradespeople, you've got tools you bought when you were employed because you had to buy them, and you bring those into the business. You give it a value, and then you can set that off against your income in that first year, which is really useful. I just wanted to briefly talk about limited companies because I'm just keeping an eye on the time, because I'm aware that there are some people who've got limited companies as well. So if you're a director of a limited company, then you will still probably have to complete a self-assessment tax return, because you're probably getting dividends. So dividends are something that is paid by the company to shareholders as a payment for the investment that they've put in to start that company. Quite often as well, you'll be paid a salary, because it makes sense to have a salary scheme in a limited company. You pay 20% corporation tax, 19 to 20%, depending on where you are. And if you pay yourself a salary, that's a cost to the business, so reduces the profit. So quite often company directors, shareholders will pay themselves a salary and a dividend, and you need to declare that on your tax return. The other thing I wanted to touch on there was the timing of income as well. As a self-employed person, normally most people would have their accounts finishing 31st of March or the 5th of April. So it coincides with the tax year. It just makes it easier to follow, easier to understand. However, I started my business on the 1st of January. So my year end is the 31st of December, which is absolutely fine. And that December, for example, this year, December 2020, falls into the tax year ending the 5th of April 2021. So when I report my accounts to the 5th of April 2021, it will be actually the figures of my business for the year ending 31st of December. And that's allowable, it's fine to do. But for limited companies, it's usually the case, because when you start a limited company, you start it when you start your business, and therefore your year end, they'll all be different. You can change your year end as well, but it just means that your dividends and salary, for example, might not coincide with the tax year. So it's just knowing when you actually receive it as opposed to when the limited company's year end is. So that's just something to be mindful of. And with limited company accounts, you have additional things to do. So you have accounts to file with Companies House, and you also have accounts to file with HMRC, because HMRC will ask you to complete a corporation tax return, because you pay corporation tax on a limited company, whereas you pay self-assessment tax if you're a sole trader. The payment of tax and those deadlines are 9 months. So you need to report and pay tax within by the 9 months after the year end date. And there's also confirmation statements to do every year as well. Confirmation statements really just confirm that nothing's changed in the company. It's still operating the same way, got the same directors, same addresses and everything, but it's an additional thing you have to do as a limited company. But I just thought I needed to cover that because it's slightly different in terms of the timings. So that's really covered the tax return itself. Now, I have tried to just sort of touch on the bits that you need to remember. There are a lot of questions in there, so just set some time aside to go through it. But as I said, because you can leave it at any point, it means that, you know, you can spend an hour doing part of it and then go back to it as well. So that's really useful. Before you get to do your self-assessment tax return, in order to get to the point where you know what your income and expenditure and your profits are, you've got to prepare your accounts. And this is also the thing that's going to tell you how you're doing in your business. But again, I find that people, when they start a business, get a little bit worked up, I think, about having to do accounts and worried about having to use software, having to understand accounts. And actually, for most businesses, when they start up, it's very, very similar. And it's a little bit like doing your own accounts for your house budget. So you know what's the income is coming in, you know what your regular bills are, but you might regularly go in and check how much you've been spending on food, for example. Especially now, I think I've spent far more on food in the last 6 months than I ever did before. And I understand why. And that's okay. And I also understand that actually it's okay because they're spending a lot less money everywhere else. And it's exactly the same. So when you do your accounts for your business, it's not wrong that you're spending more than you thought. It might well be, there might be a good reason for that. And so long as you understand that and why that's happening, then that's what preparing accounts on a regular basis is all about, is knowing what you expected and then understanding any variances in that expectation, and if that's okay or not, if you need to do something about it. So treat it like that in the beginning. Keep it really simple. You can use software if you want. There's lots of free software or really cheap software out there. If I'm really honest, for a lot of people, software can get a little bit confusing. Even the simple stuff can get a little bit confusing. Because inevitably it's an accountancy package. So some of the terminology, some of where to put things can get a little bit, a bit daunting. It's something that you will need to do in time, but you certainly don't need to do it at the beginning of your business. A spreadsheet's fantastic if you're good at spreadsheets. That, you know, when you've got a simple business, it's a great way to keep a track of things. But I have clients that still use a book, a Simplex D sort of business books, the old business books you used to get, or even just little notebooks where they're, you know, keeping a track every week or every month of the money that's going in and the money that's going out. And that's absolutely fine. And for me, it's whatever works for you in the beginning that will make sure you don't forget anything. And that's the important thing, because it's forgetting things that's really important. When you're busy trying to build a business and you're worrying about everything else that's going on, it's so easy to forget, you know, the coffee that you had out at that meeting, or, you know, that bit of stationery you bought. But it all adds up. So it's really important. Whatever way you find is simpler in the beginning is the right way to be, and to manage it. Keeping a track of who owes you money and who you owe money to is really important. Software's quite good at this if you're using software, but again, you need to be doing invoicing and posting invoices to the system, and that again can be a bit complex for people just starting out. So a simple, you know, list of your invoices with a date by the side of it of when people have paid you, that will do, and just keeping a track is absolutely vital. In the beginning, lots of people have, when we start businesses, and I was exactly the same, we have this imposter syndrome where we feel that, you know, for whatever reason, we can be experts in our job and we know how good we are. But when it comes to having our own business and then going out there promoting ourselves, how good we are, you know, is something people really struggle with. So, you know, first of all, there's an issue with, and I'm sure this has been discussed, but there's an issue with, you know, your pricing for that very reason is, you know, you don't feel worthy of that amount. And yet, and the other issue is then making sure you get paid. So not wanting to sort of contact your client or chase your client. But when you agree a price, your client agrees a price, that's the deal you've done with terms of as well of when you expect to be paid. You've done the job, presumably you've done a good job. You should expect to be paid on time. And don't, you know, there are so many people out there who will need your services. You will only know this when you get several years down the line and you realize you've got loads of clients and you know, you're picking the clients that you want. But in the beginning, it feels like you need to just accept anybody. And so, you know, being a bit sensitive about the money is something that everybody finds challenging. Expect to be paid on time. And if people are not paying you on time, keep making excuses, then they don't deserve to be your client. And you have to be quite, you know, have to have confidence that you will get the right clients over time. So, you know, I just send people invoice emails to say, I'm doing my accounts, blah, 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 it's horrible stuff. You know, and for some reason, I can't find the money going in. You always seem to pay me on time. I'm just a bit worried it's got lost somewhere. So, you know, something like that is usually enough to remind people, because quite often they're honestly forgotten because people are so busy. Get the dates right. So the dates are really important as well. So you could invoice somebody now. So my year end is December. So I could do some work in December, and I raise the invoice in December and send the invoice, and my client pays me in January. Now, January is a new year for me. That job was done in this year, ending 2020. So, and I invoiced it in 2020. So the income, even though I haven't received the cash, is shown in 2020. So it's irrelevant whether you got paid in 2020. It's when you invoiced it. So don't forget then when you come to 2021 not to double count it because you've had the cash in. So keeping a track of, you know, your income is when you invoiced it, not necessarily when it got paid. That's important. And the same for you when you make purchases. You know, if you make a purchase now in December, you might not pay for that until January. It goes into December as a cost. As I said, online software, as you start to grow, there's some great stuff around now, and it's not expensive, and it will help you as you start to grow. If you can operate with a separate bank account, do. You don't need a business account as a sole trader in the beginning. You can set up another personal bank account, and banks don't like it because when you set up a business bank account, they charge you for all your credits, your checks, your pay money in and things like that, so they get money out of it. A lot of banks now are not charging the first year, and I think there's a few banks like Starling Bank are not charging businesses for that. But use a separate bank account if you can. It just makes it so much easier when you're trying to separate your personal stuff from your business stuff. You can still transfer money from your business account to your personal account as and when you need it. That's absolutely fine. But put all your business expenses through a business bank account if you can. If you're a limited company, you've got to. It's because it's a separate legal entity. Ensure you provide invoices and you get receipts, invoices as well. So whilst the revenue only expect you to put one figure in for expenses, they can open an inquiry on you at any time for 6 years after that tax return's been put in. And that inquiry can be driven by an inspector who's reviewed something and thought it looks odd. It could be driven by an investigation they've gone into one of your clients, and as part of that process, they've picked up an invoice from you and thought, I wonder if they're registered with revenue and declaring their income. It could be that it's a computer random selection, and that happens as well. So don't panic because this happens, but just know that whatever figures you're putting into your accounts, you will have to, you may have to at some point evidence that. So it's getting into the habit of getting receipts, even for those cups of coffee, even for that, 50 pence bit of stationery, get receipts. That said, if you miss a few, the revenue are not, as I said, they don't lack support. They understand. We always, all of us forget sometimes. So if you miss them, don't not put it in, still put it in, but just bear in mind that missing the odd one or two because you forgot is not the same as missing all of them, and you've just been putting in estimates for everything. So just get into the habit of asking for receipts, and you should always provide invoices for your clients for your sales of some description, even if it's a little receipt book where you're handwriting out receipts. That's absolutely fine, and they need to be dated, and they need to be new. They need to have a separate identification, unique identification, a number. You can start from 1 and go upwards, or some letters, whatever is you want really. Any personal money, as I said, is fine to move from your other bank account. It's just a class as personal money. It's owed to you by the company if it's a limited company, so just keep a track of it. And again, remember HMRC can ask to see evidence. So it's just being mindful of that. When you do your accounts, just put all your receipts together in some sort of order. It could be monthly order. It could be you put all your petrol receipts or your stationery receipts together. It doesn't have to be in a really nice file, all in pockets and organized. I've seen some accountancy, some bookkeepers, they're beautiful, but at the end of the day, I think it goes in the attic most of the time for people. So it doesn't need to be that organized. It needs to be organized so that you can put your hands on it and you can give it to the revenue. But don't worry about buying fancy files and making it all look pretty. It's too time consuming. Some of the right, where am I? Let me just make sure I am doing okay. Here we go. So some of the things that get forgotten, wholly and exclusively, the terminology with a revenue is you should only put expenses in if they're wholly and exclusively for business, and that's their argument. However, we know that we all use things that are not necessarily wholly and exclusively. So it could be our home, for example. We use our home as an office, perhaps. Even if you're a tradesperson, you might be spending 2 hours on the weekend getting all your invoices together, raising sales, doing quotes. You might be using your home or one room of your home to do treatments and things. So therefore, it's not wholly and exclusively. So there is an apportionment that needs to be done. So I'll go into that with home office. Postage, office stationery, as I said, people often forget that. Mileage and car, you can put in your car costs. So you could put in the cost of the car if you're still paying a lease or paying payments for it. your insurance, your tax, repairs, MOTs, anything like that you could put in. And then you have to identify, then if it's not a van, so it's for exclusively for business, you then have to estimate the amount of business use you use that vehicle for. So it could be that you use it for 70% business, 30% private. And that's okay, but understandably, the HMRC are a little bit nervous about that. They don't like it because it's arbitrary. Who says it's 70% or 80% or 50%? So whilst they will kind of accept it if it looks sensible for your type of business, what they do prefer is mileage. So, keeping a mileage log can actually be better in terms of expenses anyway, especially if your car is fully owned, because you get 45 pence a mile. So keep a track of your business miles. I tend to look at my diary once a week or once a month. And because my diary is filled with where I've been, I populate a spreadsheet and I just put the number of miles. What you will find is you tend to be going to the similar sort of places or same places. So once you've had, a couple of months of doing a mileage log, you'll find that a lot of repeats, and therefore it's just, it's easy to do. And then whatever many miles you've got at the end of the year, times that by 45 pence, and that's the value you put into your accounts. That's if you're doing mileage up to 10,000 miles. Any mileage over 10,000 is 25 pence, because by that time they deem that you've claimed enough to claim back the car costs, the insurance, the tax, and it's really just fuel. Your home office, this is again arbitrary. If you look at the website, HMRC's website, they've got you can £1 a week, £2 a week, £3 a week times 52, which isn't a lot. And if you're just doing a couple of hours on the weekend, you're not really using your office much, your home as an office much, that's fine. But if actually you're like me and working from home, and especially this last sort of eight or 9 months, then actually you're using a lot more of it. So one of the things you can do is take your rent, if you rent your home, you rent, or mortgage interest, not the capital, because the capital then is, you would end up paying capital gains tax on it because that's an investment. So just the mortgage interest that you've paid in the year. You can also take into account the gas and electric that you pay in the year, all of it, put it all down. And the two things I would avoid putting down are the rates, council rates or water rates. And the reason is, if you declare them as a business, then potentially they can charge you business rates, and business rates are really expensive. So just use rent or mortgage interest, gas and electric, and then work out the total for the year, divide that by the number of rooms in the house, excluding bathrooms and kitchens. So if you've got 5, maybe 3 bedrooms and 2 rooms downstairs, that's 5 rooms, and that gives you a rough amount for what to declare as your office if you're using it 100% of the time. If you think, right, I'm using about 50% of the time, 30%, then calculate it as that. So long as you've got a good sort of a structure for it, a reason for it. Any equipment, as I said, you can include. So equipment you purchased before that you brought into your business, you just need to value it at the time of the business. Any expenses you incur in setting up the business. So if you've got premises and you've had to kit out the premises, or you're repurposing a building that you've got for treatments and things, then you can include that. Bank interest charges and anything else. And what I normally say to my clients is to get anything down that you've got, and I'll tell you at the end of the year whether it's relevant or not. But that covers most of it, to be honest with you. And then just a little bit about the tax and national insurance. When you are employed, they're different rates. So for self-employment, is slightly different. Again, we all get a personal allowance of 12,500. So that doesn't matter whether you're self-employed, you've got rental income, you've got pension income, you've got dividend. It doesn't matter what. We've all got £12,500 that we can earn. That's profit, not turnover, and before we pay tax. And next year it's staying the same. And then from then on, you pay 20% tax from 12,501 to 37,500 pounds until you get to then it's 40% from then on. I'll send these slides through as a PDF so Dewi can share them as well, so you've got them. And then from next year it'll be 50%. If 50% after the 50,000, so they've slightly changed the figures there. Now national insurance is different. So you pay 2 national insurances when you're self-employed. You pay class 2 national insurance, which is a very basic weekly amount, £3.5 a week, and that you just pay at the end of the year, so it's £159. That just covers very basic your very basic things for national insurance. And you pay class 4 national insurance on profits, and class 4 ensures that you have got full pension, you've got full any unemployment benefits or sickness benefits if you end up being off sick. That is the class 4 or class 1 from being employed, that ensures that you've got enough national insurance in the pot with HMRC to pay out that full pension and sickness, etc., when you retire, or if you need it before. If you've been employed, or if you've been paying class 4 national insurance on profits for 30 years, then you're fairly confident in saying you've got your full quota, so you doesn't need to pay it after that. Class 4 is on profits between 9,501 and 50,000, and above 50,000 you don't pay national insurance. That's the upper limit. So you know, as well as tax at 20%, you will also pay national insurance at 9%. So it's slightly different when you're self-employed. So I just wanted, but as I said, the revenue site, when you do it, will calculate all this for you. And then I think this is the last thing really to touch on, which was the payments on account. And I just wanted to mention here that when you have a tax bill, when your tax bill is calculated, quite often in that first year, because you won't have earned a lot of profits and maybe you've had a lot of setup costs, your tax bill could be quite low, and therefore you pay your tax, and that's fine. But once your tax bill is £1,000 or more, it will trigger payments on account. So you will also have to pay 50% of that tax bill as well. So as well as the £1,000 you've got to pay by the 31st of January, they also require you to pay another 50%, i.e. £500, by the 31st of January. So you're paying £1,500. They don't like to be in arrears with tax, HMRC. So once it hits that £1,000, that's what you have to pay. And then in the July, so if your bill was £1,000 now for the tax year ending, I've got an example here. So your tax bill so your tax bill is 1,500 for 2021. So that's your tax bill. Because it's over £1,000, you pay another 50% on account, so £750 by 31st of January 2022 as well. So your tax bill on the 31st of January 2022 is £2,250, not £1,500. And then in the July 2022, you've got the other 50% to pay. So effectively, by the July, you've paid 2 years' tax bill. The benefit is the following year, you know, if your tax bill is exactly the same, i.e. £1,500, you'll have already paid the £1,500 in advance. So you won't have a tax bill, but you will still have to pay payments on account. So you would have a 750 in the January, 750 in July. It's a bit complicated and it catches a lot of people out. And it's another reason to do your tax return early, and also to start saving for tax as well immediately. So I just needed to touch on that. It does catch people out. So a few good practice tips, I think. Do your mileage. I think it's always a good thing to do. Have a home office claim in mind, because it's important. It is something you can claim, you're allowed to. Understand your national insurance, you know, that you need those years. You can actually check, you can phone HMRC and check if you've got, you know, your 30 years in hand. Keep all your receipts, keep it as simple as you can. I would rather somebody keep it really, really simple, but make sure they're recording everything, than try to do everything complicated and finding that they're just not getting around to it. Save for your tax. My advice is to put money aside. So if you invoice £100 for something, put 20 quid of that into a savings account. What will happen is you'll actually save more than your tax is due. And you'll have your money there when you come to pay it. You'll also have sufficient money for your payments on account. And if you keep doing that, you'll get into a really good habit, and you'll never have that horrible shock at the end of having, you know, a few thousand tax bill to pay. It's just awful. And the problem is then it's really hard to catch up then, because you're always then in arrears and trying to catch up with it. So 20% is a good measure. Collect your debts, get your accounts done earlier, then you can see exactly where you are before you need to be there. Don't ignore HMRC, and try and do as much of the accounts yourself as you can in the beginning. It really will help you understand what's happening in your business. Even if it's in a simple format, it really will help you understand. Even if you don't do the final bit of the tax return or putting the accounts together, trying to understand what's coming out of your business, and where that sits with maybe your projections that you've done, you know, why maybe it's different, is really, really important, and it will help you understand your business going forward as well. So that's it really. I mean, you did have a question, Jeanette.
Did. Yeah.
Has it got covered?
Well, my question was, I had to outlay £1,200 to get a £500 grant back.
Right.
So the rest of the money that I paid, because I'm buying new stock into the business, can I claim that back then as part of my setup costs?
Yeah. So you spent £1,200 on stock or
Yep.
or on kit and equipment. Yeah, absolutely.
No, that's fine.
Yeah, you'll have to reflect the money coming in as a grant.
Yeah.
Yeah, it's a grant. Yeah, it's not repayable.
No, it's a grant.
Just so you know, if it's a loan, it's not classed as income, because you're actually paying it back.
Yeah.
So it's money that's a loan is money that you owe. Mm-hmm. So the money sits in a separate place in your accounts, because it's money that's, you know, you've borrowed and you're going to pay it back, and as you pay it back, it'll slowly reduce the amount. So it's not income. A grant is income because you're not paying it back. So I would show it as a separate heading. But yeah, absolutely, everything you've bought with that grant and all the money you've laid out as well, that all goes in as part of your setup as well.
Perfect. Lovely, thank you. That's what I wanted to know.
Can I ask a question, Julie?
Certainly.
Sorry. Can you recommend some good online software if you are going to start off with a set of accounts? Which package would you recommend as sort of a starter?
Actually, QuickBooks, I didn't like QuickBooks, but they've done a lot now of QuickBooks, to be fair. And there's some very good basic packages, and you can get sort of packages for sort of £40 a year or something. I use QuickFile. You know, it's got slightly more sort of functionality, so it helps me in terms as an accountant. That only cost me £54 a year. So, and you can download your bank into it, so you save your bank as a CSV file, and then you can basically download it and then analyze it into your accounts. But the problem is that where to put things can get a little bit tricky for a lot of people. So that's why you know, you do it, but people then get a bit confused over, you know, where things should go. So if doing it in conjunction with an accountant is really good, or, you know, just keeping a very basic package. Yeah, QuickBooks is really good. The other thing with all the software is most accountants have can get accountants packages, and that means that you can go in and you can have access to your client. So if you have got somebody, as they're growing and they are putting stuff into their system and they're using that system, because it's online, the accountant can have access and can check things, move things, review things, and do the accounts from there as well. So that's really helpful, I have to say. And of course, you can click on a button and get a profit and loss.
Yeah,
So-
I'm often asked this kind of question from clients. I mean, at Oakbank, we use Xero, and that's been great, actually.
Xero's good.
Quite like Xero.
Yeah,
I'm
Xero's
finding
good.
it quite simple.
Yeah.
We've moved over to Xero from QuickBooks recently, so we're still getting used to it.
Yeah.
So
I think it depends on the level. QuickBooks is very basic. Xero and QuickFile are a lot more. There's a lot more functionality on it. Again, it's just, you know, it's just I spend quite a lot of time with my clients when they go onto software in the beginning, working with them on just it's helping them understand what goes where. Once they've done a couple of months and they know where to put everything, then it's fine. So there's just that learning curve really in the beginning.